Hello and welcome to episode 42 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya,
And my name is Tamanna Surya.
and today we are thrilled to have Gautam Baid, the author of Joys of Compounding and managing partner of Stella Wealth Partners India Fund, as our guest on this podcast. Gautam, I absolutely loved reading a book. You can see it in the background in my bookshelf there. And it was really good to see you in person at the Berkshire Hathaway meeting this year.
To be on the podcast, Asif and Tamanna. I'm looking forward to our conversation. And yes, we did have a nice interaction in Omaha. So hope to carry that interaction forward in much more detail during this conversation.
Exactly. And before we begin, we want to state that nothing on this podcast is meant as investment advice, and please do your full due diligence and refer to our disclaimer at the end of the podcast for more detail.
So, Gautam, thank you so much for agreeing to come on the podcast. This is a privilege for us. Could you take a few minutes to introduce yourself to the audience?
Sure. So I'm the founder and managing partner at Stella Wealth Partners India Fund. It's a Delaware-based investment partnership modeled after the original Buffett partnership fee structure. We charge no management fees, and there is a cumulative compounding annual hurdle rate of 6% before we get the performance fee. And prior to launching my fund 3 years ago, I was working with Summit Global Investments in Salt Lake City, Utah, as a portfolio manager of their global equity strategy, where I was managing around $1 billion in AUM. But before during that 4.5 to 5 year stint in Summit Global, even though I was doing well professionally, but I was really always very passionate about the Indian stock market. So one day I just decided, okay, now I've got saved up enough money to basically leave that day job and venture out on my own and set up my own shop. So then I spent the next 1 year getting all the regulatory licenses and approvals in place and setting up the structure. And then we launched the fund to the public in middle of 2022. And the fund went live on 3rd October 2022. Finally, before Summit Global, I'd worked at the India, London, and Hong Kong offices of Citibank and Deutsche Bank in their investment banking department. I'm a CFA charter holder and an MBA finance by education. But value investing, and in particular, public market investing, is my first love, and that is what I just love to do. And I hope to discuss a lot more in detail during our conversation today.
Absolutely. Gautam, we can jump right into it. You kind of covered this already, but could you tell us a little bit more about when did you start investing? And then you mentioned public markets are your true love. What really drove this passion for investing?
So Tamanna, like most investors in the public markets, I was also lured or attracted into the stock markets out of sheer greed during the final euphoric phase of a bull market. In my case, it was the 2003 to 2007 bull market in India. I had entered the public market space in late 2007, and I still distinctly remember I had purchased a mutual fund called Reliance Power Sector Mutual Fund in December 2007 and a steel stock named Ispat Steel in January 2008, because both of these investments or these particular stocks and mutual funds had appreciated very sharply in a very short span of time when I'd first noticed them. So I blindly extrapolated the recent price trends in them without paying any heed to their valuations or underlying business models. And I eventually paid the price. Both those investments crashed 70 to 80% within the first 12 to 18 months of my purchase, and had successfully gained admission into the stock market by paying my tuition fees. Despite this initial setback, however, my interest and curiosity about the public markets remained very high throughout the first 7 years of my professional job career in investment banking. And one day I just thought to myself that we just have this one single life to live our dreams, and I did not want to waste any further time wasting my precious time doing something that I was not truly passionate about. So I quit my day job in Deutsche Bank and I relocated to the US in May 2015. I was a CFA charter holder, so I thought this degree will definitely help me in getting my desired stock market job. I wanted to basically work on the buy side and then eventually become a portfolio manager 12 to 15 years down the line. But after the initial struggle of 1.5 years, wherein I had applied to more than 1,300 jobs in the US, I finally landed my dream job profile in around late 2016 in Summit Global Investments, and that is when I became a portfolio manager with them. And like most investors, the real passion for value investing really occurred in 2013 when I came across Buffett and Munger's teachings for the first time. I think from late 2007 to late 2013, essentially I was engaging in very short-term trading, futures and options, day trading, positional trading, swing trading, and basically the wins and losses used to cancel themselves out. It used to essentially be a zero-sum game. So I thought, I'm so highly educated. I'm a CFA charter holder. I'm an MBA in finance. I've worked in Citibank, Deutsche Bank. How come I'm unable to figure this thing out? In hindsight, I realized I was lacking a structure. I was lacking an strong intellectual foundation in investing. If you want to be a good lawyer, what do you need to do? You need to study and practice. If you want to be a good doctor, what do you need to do? You need to study and practice. Similarly, if you want to be a successful value investor, then what do you have to do? You have to study and practice. So from late 2013 onwards, the passionate pursuit of lifelong learning began. And I very happily call myself a lifelong student of the market. The market is the ultimate humbling machine. And this is a profession in which you have to deal with uncertainty every single day. When you basically wake up and you start your new trading day, then you don't even know what's going to occur nationally or internationally or to any particular industry or the underlying company that you're interested in. So you have to be comfortable with embracing uncertainty, and you have to train yourself to think in terms of probabilities, because investing is a probabilistic activity, Asif and Tavanna. And once you understand this one fundamental attribute of the investing field, that is when you start to think in terms of odds, and you start to think in terms of risk reward. And that is when you truly become a value investor, because value investing is nothing but getting more value for the price being paid with the lowest level of risk. That is basically the broad picture with which I operate.
Absolutely. You mentioned being a lifelong learner. I think that's something you start your book, The Joys of Compounding, out with, right? The concept of being a lifelong learner and always pursuing your passions and curiosity. Could you talk about some of the mentors that have shaped your journey? I know you mentioned Buffett and Munger as well. And is there anyone else in specific that you look towards when you're looking to learn?
So there's a full list of so many individuals in the acknowledgement section of the Joys of Compounding, which you may have come across. In fact, that book itself is a celebration of the value investing discipline. It has got inputs and insights from more than 200 of the greatest thinkers and greatest minds in history. So you get to learn so much from every single subject matter. Be it philosophy, be it psychology, be it history, be it mathematics. You have different teachers from different fields, and you just keep learning from each of them, and you'll over time you realize that investing is a very multidisciplinary field. Basically, you need to learn the big ideas from the different disciplines, and then you basically use one or two big mental models from each discipline to make more informed and more better decisions as an investor. So basically, not just Buffett. If I just talk about the investing field, for example, apart from Buffett and Graham, I've learned from Howard Marks, Phil Fisher, Peter Lynch, Terry Smith. You can just, and from within India, there are so many investing greats: Bharat Shah, Ramdev Agarwal, Mr. Ramesh Damani, the late Rakesh Junjunwala. There are so many people you can actually learn from. But you basically learn from everyone. But at the end of the day, investing is a very individualistic sport. So you take the best ideas and then you tailor them to your personal attributes, your personal personality, your personal temperament, your personal behavior. The best investing strategy is one that you can stick with for the longest period of time across market cycles. The investing strategy should work for you. There is no one single road to heaven in the investing field. So be it deep value, be it growth at a reasonable price, be it special situations, or be it any other form of or commodity investing or cyclical investing. Once you pick a particular niche within the investing area, then you should stick to it and not abandon that when some other theme of or style of investing becomes in favor. Because in bull markets, sometimes certain strategies underperform. That is the time you have to remain true to your investing philosophy, and just ride that phase out, because eventually mean reversion or reversion to the mean is the iron law in the field of finance. So you have to have patience and stick with your knitting, not just change it with every market cycle.
Absolutely, Gautam. I mean, that resonates so much with me because I've shifted strategies and styles, added more to my portfolio of ideas, if you will. But there have been times where I've wholesale moved on from, being just a value investor to a special situations investor and so on and so forth. And bad markets really test your conviction, if you will, not just your patience. And so I had read that Bill Miller reads The Reminiscence of a Stock Operator each year. And in many ways, I think your book is one that should be read every year. Your ability to crystallize ideas across various investing strategies is just unparalleled. So, as you mentioned, investing is multidisciplinary. And your book, as you mentioned, has brought together a lot of these ideas across so many of these investors. And so I just enjoyed reading it. There were new ideas that I found in there, but there were so many of these things that you've come across before and you either forget or need to be reminded about once again. So reading a book, I think not just once, multiple times, makes a whole lot of sense.
Thanks for the kind word, Asif. Yes. So basically, the Joys of Compounding was written with that objective in mind that, you know, any, new student to the value investing field can simply get a good refresher on, various investing styles and philosophies. And more than, stocks and business fundamentals, the Joys of Compounding essentially illustrates how value investing is a life philosophy. It's a way of life. It's not just about money and investing only. It's about how you design your life for maximum fulfillment. And that is, how most true value investors actually tend to organize their lives.
Absolutely.
That makes perfect sense. I want to move to something else. In the past, you've said that the stock market is a complex adaptive system with trillions of moving parts. This ties to another idea from your book that really stands out, the erosion of the informational edge. You talk a lot about how a few decades ago, hedge fund managers with the most information were the ones who performed the best in markets. However, with the invention of the internet and proliferation of information practically everywhere, you mentioned that having the right temperament and understanding the behavioral aspects of the market is what becomes a lot more important. What is your stance on this idea now that AI has only increased our access to all sorts of information? Is harnessing AI the next line to cross, or does AI actually increase the importance of the behavioral edge instead?
Completely agree with the last statement, and you're very right. 50 years ago, the best investors were the ones with an informational edge. But with the widespread dissemination of information through the internet, the information edge is basically now non-existent. The second kind of edge, which investors used to have previously, was the analytical edge. But with more and more smart people entering the investing profession, even the analytical edge is fast getting compressed. But the one edge, which is the most durable and sustainable in my view, is the behavioral edge. The behavioral edge essentially refers to your personal temperament. And today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset, willingness, and discipline to take a long term view about the intrinsic value of a business. And with the with the widespread noise because of social media, patience levels are significantly and fast decreasing, both in retail investors and money managers alike. And this is where practicing delayed gratification, having a long-term mindset, can definitely lead to big edge as an investor, because we get bombarded with so much noise and news flow on a daily basis, but very few people tend to sit back, reflect, and ask themselves, will this news flow be relevant a year from now? Just whenever you come across any particular piece of news in the media, just ask yourself as an investor, will this news stand the test of time? And will I be thinking about this even 1 year down the line for my businesses in which I'm investing in? Most of the times you'll realize that it is just short-term noise. There's no long-term signal in it. And that is how you basically get an edge over many market participants, because most of the market participants are majorly into instant gratification. They're looking for the next big lottery ticket. But the stock market is not a place for generating income. It's a place for building long-term generational wealth. And once you reorient your mind from day-to-day trading or volatility to long-term business value creation, that is when you basically get a big edge over many other investors in the market. And patience is a great equalizer across the financial market cycles. And this is what you need to hone personally.
That makes perfect sense. So simplify within all the noise, really focus in on the information that matters the most. I wanted to ask, how might that tie to price action? I saw Michael Lewis recently gave an interview where he says he believes in price action and that price reflects a lot of the information the market has. And I was doing some of my own research and saw you said something similar as well, that the market will lead you to the right investment ideas, especially after a bear market where new leading industries emerge. So, could you tell us a little bit about how an investor can outperform if the market is already so good at incorporating and adapting to information? So, is there much of an edge there? Where does price action factor into everything?
Well, you mentioned a very important point. See, everything, in investing, see, investing, like I mentioned, is a probabilistic activity. There's no black or white in the investing field. It's all shades of gray. And when I talk about price action, you have to place it in the right context. So during a bull market, when many stocks are hitting 52-week highs, you want to look for stocks which are hitting multi-year highs. In a range bound market or a sideways market, you want to look for stocks which are breaking out to fresh 52-week highs. And in a bear market or immediately after a sharp market correction or a bear market, you want to look for stocks which are hitting a 3 month or 6 month high. The whole idea behind observing price action is to identify pockets of relative strength in the stock market. And the market collectively is far wiser than any of us individually, right? So you want to pay heed and pay respect to the collective wisdom of the market, not blindly follow price action, but it's a good starting point for researching new ideas. So, for instance, when I use screening tools during the course of my daily research, I try to look for stocks which are hitting a fresh 52-week high or a multi-year high, and then I start doing the deep dive on their individual business fundamentals by reading their annual reports, credit rating reports, also trying to get a good understanding of the competitive landscape of the industry. So it's a good starting point for initial research. Also, if a group of stocks start going up rapidly at the same time together, and if that sector has been highly neglected and out of favor for a long time, then you should definitely pay attention because it may be alerting you to a turnaround or an inflection point in that specific industry's fortune. So this is basically how you tend to use price action for getting new ideas to research on. Basically, over time, as a highly engaged active investor, you develop what I call a feel for the market. So basically, you have to be your portfolio and yourself. Both have to be aligned with how the market, which way the market is flowing. You cannot, you should not go against what the market is trying to tell you. So this is why being a contrarian investor is so difficult. It's not easy. It's intuitively not easy because you're trying to essentially go against what the market is telling you. So you should use a mix of both. You can be either a contrarian or you can align yourself with the market and focus on fundamental momentum.
Gautam, you said a very important point about, multiple companies within the same industry rising up from the bottom. We see that as an early signal through insider transactions. So after an industry like really gets bombed out, like the biotech nuclear winter, if you will, we had last year or the last couple of years, we start seeing a bunch of insiders buying. And I know when Tamana first started writing for Inside Arbitrage, I gave her a bunch of regional banks to write about because we had the regional bank crisis. And she was like, every week you're asking me to write about regional banks. And I would tell her that that's what's happening. The insiders are buying hand over fist. So the best ideas that are showing up are regional banks. And the same thing happened earlier this year. She was writing about a bunch of biotech companies because that's who the insiders were focused on. And that's the kind of ideas that we were seeing. So you make that very important point. Look at like cluster buying or companies that are rising off of a bottom within a specific industry.
Absolutely. In fact, I do track insider bank data on a daily basis, and you're absolutely right. See, the insiders are the most informed people inside the company. So, when you observe insiders hiking stake or making purchases from the open market, when the industry is in neglect and out of favor, and in a downturn, definitely you should start paying attention because there's so many cases of these insiders issuing warrants to themselves or making purchases from the open market just during the industry down cycle because they are aware of that eventually the cycle will turn, and that is
Yep.
when see, there are many reasons for insiders to sell, but there is only one single reason for insiders to buy. They believe the stock price will go up. So definitely it's a very good metric to track.
And to add to that, we've been tracking insider transactions for 15 years, and Tamana and I look at it every night together. We read the footnotes of every filing. So the second reason they buy is sometimes to signal the market because they know that you and I are going to be looking at this data, right? And so for us, trying to figure out that nuance and remove that noise from the data has been the more challenging part and the more interesting part. And I believe that's why the edge still exists there. So, moving away a little bit from the book, I wanted to congratulate you on completing 3 years of your fund, Stella Wealth Partners India Fund. And I wanted to learn a little bit about it. Why did you decide to use a fund structure as opposed to separately managed accounts? And the framework you use to run your fund, as well as how concentrated or diversified your portfolio might be.
I'll answer the second part first. So basically, I focus on an investment philosophy of prudent diversification. So I hold between 20 to 25 stocks at any point of time, diversified across industries and risk factors to avoid single factor risk. I purchase new positions for the fund with an initial allocation between 3 to 5% at cost, and subsequently average upwards if the management executes above my expectations. And individual position sizing is important not only for portfolio performance but also for your personal peace of mind. I sell down to my sleeping point if a single position becomes a discomfortingly large percentage of my portfolio by value. And one should have higher weights in businesses with high longevity, solid growth prospects, and disciplined capital allocators. As Mae West has very rightly said, too much of a good thing can be wonderful. Now, talking about the SMA versus fund structure, I think it's much more easier to just operate one single fund instead of operating multiple SMAs. I know with platforms like Interactive Brokers and others, you can actually execute orders across multiple individual accounts with one single click. But somehow the fund structure just appealed to me intuitively, and just to have it's a pooled investment vehicle. So all the investors' capital gets pooled into one single account and then invested into the underlying portfolio, and no, all the investors essentially earn the same returns. Just like me, and like all of my personal equity allocation, for instance, is invested in my India fund alongside my investors. By doing so, that incentivizes me to focus on downside protection and risk management at all points of time. Because for my investors, it's just a small part of their equity allocation. But for me, 100% of my equity allocation is inside my India fund. So the structure has been very thoughtfully designed. The zero management fee incentivizes me to focus on return maximization, and the 100% skin in the game incentivizes me to focus on downside protection as well. So that is how I've structured the fund, and it's a long only fund. No short selling, no derivatives, no leverage, no bells and whistles. Simple long term investing in good quality stocks or mispriced stocks in the Indian markets. That is where I've been investing for the last 2 decades, and this is something which I love to do anyway. So I'm actually I've turned my passion into my profession, and that is why you're always very excited when Monday morning finally arrives every week.
That's wonderful, Gautam. I manage separately managed accounts, and yes, there is some level of pain to doing it that way, especially if you have an options overlay on top of that, because you buy a position, a bunch of stock gets allocated to each of those individual accounts. And sometimes I've found that one account is a few shares short of me selling an options position on top of that. So yes, the fund structure definitely makes things easier on that front. I wanted to talk about one of your frameworks that's close to heart for us, which is special situations. As you know, this is a special situations report podcast. So we've been asked over the last several years about why we don't cover special situations like spin-offs or merger arbitrage in other markets. And there are two reasons. One of them being that we don't know if there's enough of these special situations that occur in other markets, like India, for example. And the second is there are many nuances, especially when it comes to regulatory approvals and other factors that have to be understood to make a probabilistic bet on these situations, right? So can you touch upon this, the volume of special situations you see in India, and how you handicap them in terms of understanding the probability of, for example, a deal closing or a spin-off where the spin-off is more attractive than the parent, or maybe the other way?
This is also a topic which is very close to my heart, Asif. So we'll be happy to talk about this in great detail. In fact, special situations are happening all around us in various stock markets across the world. But speaking specifically about the Indian markets, there are special situations which occur on a regular basis almost every month, and which are very lucrative. I'll talk about various special situations in detail with you guys now. Starting with, in US we call them spin-offs. In India we call them a demerger. So I'll give you an example, past example from my India fund itself. So 2 years ago, there was a company called Aarti Pharma Labs. It was spun off from its parent, Aarti Industries. Now, Aarti Industries was basically a mid-cap mid-cap chemicals company, and Aarti Pharma Labs was a small-cap pharma company. So now observe what happens here. In such kind of spin-offs or demergers, there is a huge element of force selling. And this force selling component in demergers and spin-off is what leads to the biggest bargains and value opportunities. So immediately after listing, Aarti Pharma Labs faced intense selling pressure from both the chemical-oriented funds which had invested in Aarti Industries. They also faced a lot of selling pressure from the mid-cap mutual funds which were holding Aarti Industries, and they got shares of Aarti Pharma Labs, a small cap, in their portfolios. So they wanted to discard the stock of Aarti Pharma Labs at whatever price they could get. So because of this institutional rigidity and constraints, a chemical fund cannot hold a pharma stock. Similarly, a mid-cap fund cannot hold a small-cap stock. Both these categories of funds started dumping the stock of Aarti Pharma Labs on the market after the spin-off. And and how do you identify that the bottom for the stock has been made after the initial selling? You basically carefully observe the daily volumes. Basically, the stock in India, we have a concept called a circuit breaker. For the first 10 days, the spun-off entity trades in a T2T segment, trade for trade segment, under which the daily lower circuit limit is 5%. It cannot fall more than 5% per day. So typically in these kind of spin-offs, for the first 6 trading sessions, the stock is in 5% lower circuit on a daily basis on very low volumes. You want to watch for the burst of trading volumes. Once on the 7th or 8th day, when you observe big volume surge, that is when you know that these institutional funds are basically getting an exit. That is when you make your entry. Basically, because the small cap space in India is pretty illiquid, but you get tremendous amount of liquidity and trading volume when these big institutional players are doing this force selling in these spin-offs. So in this case, the spun-off entity became much more attractive after it listed. The second kind of situation, when do we buy a demerger or spin-off opportunity? Before the spin-off has actually happened. So if the more dramatically opposite or different the existing business and the business which is going to be spun off, the more the potential for value creation. Basically, the more bipolar the two businesses are, the more there is a potential for value creation. Many times, basically, there is a very attractive business segment within an overall entity, which is expected to get a very high valuation multiple. But because it's inside a overall badly managed parent company, the overall parent company does not get the actual right valuation which it should be getting. But if you know that the spun-off entity is going to get a much more higher valuation than the parent entity, then you can buy it, even before the spin-off actually takes place. Because these parent companies tend to trade at a discounted valuation because it's a mix of bad business and good business. So in those cases, you can buy it before the spin-off. You buy after the spin-off when you anticipate that there's going to be a big element of force selling. Otherwise, you buy it before the actual spin-off takes place. So I explained about spin-offs now. Now let me explain one more special situation which I've practiced in my fund 2 years ago. It's on merger arbitrage. You must be very conversant with this topic. So we bought a stock called Inox Wind Energy Limited 2 years ago. For every one single share of Inox Wind Energy Limited, you are going to get a certain number of shares of Inox Wind Limited. Okay. And based on the merger ratio at that particular point of time, there was a 20% merger arbitrage discount on the table. All that you have to do in such situations is to make a calculated assessment of whether the merger will eventually go through. And how do you do that? You look at history again. Basically, in India, in sectors of national strategic importance like defense or telecom, or banking, for example, there may be some concerns about certain mergers going through. But in this case, because this company was in the Inox Wind Limited was in the business of renewable energy, and there was a reasonably high certainty of the merger basically going through. It was not really industry of national strategic importance per se or national security per se. Also, how do you I talked about maximizing odds as an investor, right?
Mm-hmm.
In these situations, if the underlying business, if the entity which is being merged is also experiencing massive sector tailwinds, then there is an added layer of basically you're putting the odds in your favor even more. Basically, the renewable energy sector in India is undergoing a massive tailwind because of the thrust of the Indian government on that particular sector. So in these situations, along with the merger arbitrage discount, you also want tailwinds in the underlying industry, which is being, of the company, which is being merged into the holding company. That what happens as a result, the underlying entity, the Inox Wind Limited stock price also started going up. And the more it went up, the more the merger arbitrage discount kept on widening. So, eventually when the merger was finally completed a few months ago, this merger arbitrage situation, because of the growth in the intrinsic value of the underlying business, gave you returns of more than 80-90% in just 2 years. So it was a very, very profitable merger arbitrage situation. So focus on tailwinds in the underlying industry. In merger arbitrage situations, you have to have a favorable view on the underlying business. That is basically when you get those big, big winners in merger arbitrage. Now, one more special situation, one of my favorites, management change. And within management change, there are two categories: management change amid industry tailwinds, and management change in a very highly competitive industry. So I'll give examples of both. So there's, after the Russia-Ukraine war, you have seen multiple other wars break out across different parts of the world. India, Pakistan went to war, then Israel, Hamas went to war. You had and Russia, Ukraine is still in war globally, and plus Donald Trump has now urged his European counterparts to greatly increase their defense spending on defense as a percentage of GDP. NATO has to step up their defense spending. India is also stepping up its defense spending. So what do I understand about all this as an investor? Industry tailwind. Defense is going to be a structural theme for the next many years going forward. So 1 year ago, there was a company in India called Axis Technologies. Basically, they are focusing on electronics, AI, and defense. And majority of the revenues right now is being driven by the defense segment in that particular company. There was a management change which happened amid industry tailwinds for defense. That stock has doubled in just one single year. One more example, when you have management change and basically in a particular company in which the industry is experiencing tailwind, but the company is not being properly managed or well managed, then also you get a chance of a multi-bagger. So Mahindra & Mahindra acquired a company called SML Isuzu earlier this year. SML Isuzu basically has a very good product in light commercial vehicles, but they have very average distribution capabilities. Enter Mahindra & Mahindra, okay, as a new management and new owners of the company. And because they are very strong in distribution and SML Isuzu already had a good light commercial vehicle product in place, amid industry tailwinds for the light commercial vehicle sector, the stock of SML Isuzu has also doubled in the last 6 months. Again, so these two are examples of management change amid industry tailwinds. Now, which are the situations in which you need to be careful? Not all management change situations lead to value creation. So recently, there was a company called VIP Industries. It's a market leader in the organized luggage space in India, luggage industry in India. And Multiples Equity, a private equity player, they have taken over the company and and they have instituted new management in VIP Industries. However, even though here Multiples Equity has got a good track record as a private equity player in turning around various businesses in the past, the organized luggage industry sector in India is facing immense headwinds from unlisted private players, D2C brands, direct to consumer brands, which are being funded by venture capital. So there's the competitive intensity. When you industry tailwinds is important, and low competitive intensity is even more important, because in investing, competition acts as friction for value creation. The lower the competition, the better the odds for you as an investor. So you want to look for one, like Buffett has taught us, 1 foot hurdles that you can step over, and not 7 foot hurdles. So these are, I give you examples of spin-offs, merger arbitrage, and management change. One more very good example. So basically, sometimes you get a conglomerate which is basically engaging in stake sales. So there's a company called Edelweiss Financial Services. In fact, it's one of the biggest. I think it's a top holding in Pabrai funds as well. And Edelweiss Financial Services is engaging in stake sales in various of its businesses, be it the alternative investments management arm, followed by mutual fund stake sale, followed by stake sale in its insurance business. And if you do a simple SOTP, sum of the parts valuation of that company, it comes to around 25,000 crores. The current market cap of Edelweiss is just 12,500 crores. Why is that? Because these conglomerates or these holding companies, they tend to trade at what is known as a holding company discount. Right now, the holding company discount is 50%. But over the next, so these kind of situations are a bear to bull market cycle play. In a bull market, this discount narrows. This discount to the underlying intrinsic value starts narrowing in the holding company stock. And that is when you get a sharp appreciation in the stock price. So recently, a lot of big investors in India have entered Edelweiss Financial Services through Block Deals data, which is publicly available. And they are basically not playing for just 10-20% return. They are basically betting that, okay, right now the discount is very big, but over time, as Edelweiss engages in these stake sales, and the true value is discovered by the market, the SOTP valuation will start going up, plus the discount to the underlying business will also narrow down. That is how they'll make the big money. So this is also a form of special situation, which is catalyst. Basically, special situations is nothing but value investing with a known catalyst. Without a catalyst, there is no special situation. And more importantly, the catalyst has to be publicly announced. Unless it is publicly announced, it is just a speculation. But once the catalyst has been publicly announced by the company, that is when the special situation gets activated. In fact, one of my all-time favorite books is You Can Be a Stock Market Genius by Joel Greenblatt, in which he talks about all these special situations. It's a must-read for anyone who's interested to master the special situation game.
Yeah, absolutely, Gautam. When I was talking to my publisher to publish my book, they asked me, hey, why do you want to write a book on special situations? And I told them Greenblatt's book, which is a favorite of mine as well, it's been 25 years since he's published it. And there have been quite a few developments and interesting case studies. So I ended up writing a book with, each chapter dedicated to one special situation with two case studies. One where things worked out great. For example, GE was one of those things where it was a management change, where Larry Culp coming on, and then they did spin-offs. And to your point, I bought right before the last spin-off happened because there was value in the combined company before the spin-off. And then there are situations where, it didn't work out. So we wanted to present both sides of it. It's the same special situation, but, a case study on where it worked out and where it didn't work out.
Earlier this year, if there was a spin-off in the US called SanDisk. It was spun off from its
Yes.
parent entity. And again, you had a spin-off in SanDisk, and you had massive industry tailwinds in memory chips because of AI. So that you've seen what the stock has done after listing.
Yeah, so I bought Western Digital before the spin-off, and my friend Rich Howe runs a podcast called Special Situations Stock Spin-offs Podcast. And I was a guest on his podcast talking about Western Digital. So that whole podcast is talking about the Western Digital spin-off of SanDisk. And you're right, it worked out well for two reasons, right? So there was the tailwinds from AI and the need for data storage. And they had a cyclical business, which is this memory business of SanDisk, hidden inside what was a secular grower, the hard drive disk drive business. Even though it's growing slowly, it just grows almost double digits, 10, 12% a year. So in that scenario, I basically bought before the spin-off happened because I felt like both parts had a lot of value pre-spin-off. Absolutely, yep.
Right. Basically, there's one simple trick to know when to buy it before the spin-off. If the combined entity trades at a lower valuation multiple than what the spun-off entity would trade at after the spin-off, then you can or you should buy that stock before the spin-off has happened. That's a simple mental model.
And in this case, you also had the situation where you had it was a duopoly with Seagate. And so you had the competitor, and you can look at the valuation of the competitor and realize that Western Digital was trading at half the valuation of the competitor. So that made things a little bit easier.
Correct. Yep. Agreed.
Yes, of course. So like you were saying, looking at forced sell-offs after a spin-off or even buying a company pre-spin-off or any of the other special situation signals you mentioned are a great way to find ideas. There are a couple other frameworks that you also follow, such as looking at or looking for dividend growers, and then financial leverage after an IPO. I was quite curious about your process to find these ideas. So in the sea of information, how do you find interesting opportunities? You talked a lot about like price action earlier and the market leading you to ideas. You talked about reducing noise. So how does your research process look like, and how do you find these specific ideas that fit in within your frameworks?
So I'll talk about dividend growers first. So Tamanna, a high dividend yield stock without growth is good for preserving wealth, but for growing your wealth over time, you basically want companies which can grow earnings coupled with growing dividend payouts. So, in India, for example, just like in the US, we have got real estate investment trusts. In India, also we have them, but we also have something called different investment trusts for different sectors. For example, in the power sector, we have got a stock called IndiGrid Investment Trust, in which the underlying assets are in the industry of power transmission. And as we all know, power transmission is undergoing a massive tailwind globally, including India, because of AI and the need for power, for building out the power infra. So this particular stock was trading at a dividend yield of more than 10.5% 6 months ago, and because that the power transmission assets which it holds, the earnings from there will keep on growing over time over the next 5-10 years. So as a result, your absolute dividend payouts, are basically increasing, with each year, the management keeps increasing the dividend payout amount. So on your original cost, you end up with a very, very high dividend yield. And that is how you also, grow your wealth. So, you want, and growth is essential if you want to, basically focus on capital appreciation and grow your capital. If you want to just preserve your capital, then high dividend yield stocks are okay. But if you want to grow your capital, you want to focus on growth in the underlying assets as well. So these are value to growth opportunities, which are very rare in bull markets like we are experiencing right now. But if you work hard enough, you definitely can find such opportunities. Talking about financial leverage after IPO, that situation refers to companies which have just gone public and they have used most or all of the IPO proceeds to pay down their legacy debt. Now, as debt goes down, interest cost goes down, so your net profit goes up, market cap goes up, number one. Number two, because debt is a part of capital employed, your return on capital employed also goes up with reduction in debt. So therefore, you get valuation re-rating also. So in India, for instance, in the last 6 to 12 months, we have had many IPOs, including Bellrise Industries, which is basically an auto ancillary company, caters to two-wheelers, three-wheelers, four-wheelers. We have got a company called Sai Life Sciences. They are into contract manufacturing for Innovator Pharma. Then you have got a company called G&G Electronics. They are a reseller of refurbished electronics. You also have a company called Innova CapTab. Basically, in all these four cases, the companies paid off their high cost, interest cost legacy debt with the IPO proceeds. And in the quarters after they got listed, even though the revenue grew single digits or low double digits, the bottom line growth has been far, far higher because now there is no interest component. So basically, stock markets love year-on-year earnings per share growth and net profit growth. So that's how you also get big winners in the market.
A lot of sense. Another idea I wanted to touch upon is that Buffett is pretty much known for saying it's better to buy a great company at a fair price than a fair company at a great price. You also seem to be a pretty big proponent of this idea, especially for when finding stock picks. So, when approaching investment ideas, how do you navigate the difference between great companies versus great stocks? And then what determines a fair price?
The last part of your question is the most important. What determines the fair price? And there's so much
Mhm,
noise all around us. That this stock is expensive, this stock is cheap. So I would just like to put this
mhm.
entire noise to rest once and for all. So there are two white papers. I'll just recommend here to everyone. First is called "What Does the Price to Earning Multiple Mean" by Michael Mauboussin. The second white paper is titled "The P Ratio: A User's Manual" by Epoch Investment Partners. If you just read these two white papers, you will understand how the interplay of growth and ROIC, return on invested capital, how these two metrics determine the fair valuation multiple for any listed stock in the entire world. So basically, if you figure out the fair valuation multiple for any stock using these two metrics, after reading these two white papers, if you buy the stock at a lower valuation multiple than the fair multiple, then along with earnings growth, you will also benefit from valuation re-rating over time. And if you buy higher than the fair P multiple as driven by these two metrics, then over time you'll benefit from earnings growth, but you may also face some valuation derating as the valuation multiple converges to the fair valuation multiple. So just read these two white papers to get a very good hold of what is the fair or justified valuation of P multiple for any listed business in the stock market.
Absolutely. We'll make sure to check them out.
And that's interesting. And Gautam, I've heard you talk about using a reverse DCF to understand what the implied value might be for investors out there, and then how your process might be different from that, or how your valuation might be different from that, and having a differing opinion. But I wanted to also jump off to another framework that you use that's actually quite close to my heart beyond special situations, and that is factor based investing. So more than 10 years ago, I had built a factor-based model. Clearly, there were some issues with it. I ended up rebuilding one a year or two ago, and we call that model the IA score. And we classify every company in the US based on the IA score. And recently, some of my investment ideas have come from that. I've looked at the model with the highest rated stocks, and then I've run some of those stocks by industry experts. And when I found that the industry experts realized why these companies were rated so highly, it became an idea that I invested in. However, that said, Gautam, investors have relied on factor based models in the past and have not had a lot of success. So, if you think about James O'Shaughnessy in the 1990s, or even Joel Greenblatt with his magic formula, and many others. So, how are you approaching factor based investing in light of this problem that others have faced with just using a factor based investing approach?
So I'll share my definition or my approach to factor-based investing. If you basically want exposure to a particular factor, which is in a major upcycle or which is in favor, then you want to look for the pure play listed options in the public market space. So simple example, we do know after US confiscated the forex reserves of Russia for invading Ukraine, globally central banks started stockpiling gold in a major way, and the structural bull run in gold started after the Russia-Ukraine incident took place, right, for the last 3 years. In India, you have got certain gold financiers. For example, you have got India Infoline, you have got Manappuram Finance, you have got Muthoot Finance. But among all these players, which is the player with the largest exposure to gold loan financing? Muthoot Finance. So basically, you want to maximize your exposure to a given factor, and you want to look for the best pure play to play that factor upcycle. So Muthoot Finance, was basically the best pure play that you got if you wanted to play the factor of rising gold prices. In case of Manappuram Finance, along with gold financing, they also have other bad businesses inside their company like affordable housing finance and microfinance, which are facing headwinds and problems. In case of India Infoline, they faced regulatory problems because of a clampdown by the Reserve Bank of India on their business. And there's also one more company called Federal Financial Services, known as FedFina. They are now restructuring their business, getting rid of their unsecured lending book to focus more on secured lending, including gold financing. That may be an interesting play, but you essentially factor investing means that you want to maximize exposure to a certain factor, which is in a big upcycle. One more example. I give the example of rising gold prices as a factor. Now I'll give the example of rising ferroalloy prices or ferrochrome prices as a factor. So South Africa is the largest producer of ferrochrome in the world. But in the last 6 months, the production of ferrochrome has collapsed in that country. You know why? Because of surging electricity costs. All the mining smelters for ferrochrome are simply shutting down, and there is a big energy crisis taking place in South Africa. And these commodity prices are globally driven, globally price driven, globally linked, right? So in India, the only listed pure play to play the upcycle in the factor of ferrochrome is a company called IMFA, Indian Metals and Ferroalloys. So basically, you take a long position in IMFA if you want to play the factor, or if you want to maximize your exposure to the factor of rising ferrochrome prices. There is a website called bigmint.com which I use regularly. It gives you detailed news and insights on both ferrous metals and non-ferrous metals. Ferrous metals are basically steel, iron ore, graphite electrodes, and ferroalloys. And non-ferrous metals are aluminium, nickel, lead, zinc, and copper. And just a few months ago, I read the news on that website saying that Indian ferrochrome prices have hit a 1-year high. That sparked, because I do this on a daily basis, I go through that website on a daily basis to track commodity pricing. I got curious as to why is this happening. So I simply did a simple Google search for ferrochrome. And that is how I got to know that there was a crisis in South Africa, because of electricity, which was leading to the surge in ferrochrome prices. So, there are so many ways in which you can just generate ideas. If you're just intellectually curious and thinking about the world all the time, what's happening, you can never be short of ideas in this profession.
Absolutely. It's a great way to learn, and it's a great way to be a lifelong learner. And I always say these podcasts are great because we hope to add value for our audience, but we both are also learning from our guests as we go through this. So we really enjoyed learning about these different frameworks, and a few other frameworks that you use that really stood out to us were speed breakers, volume shockers, and then proxy investing. We're not as familiar with these concepts ourselves, so could you dive into these ideas a little bit further? And then how they drive your investment approach and firm? And then more importantly, where do you find value within these ideas or frameworks?
So I'll talk about speed breakers first. So basically,
Mhm.
there are both temporary speed breakers and permanent speed breakers. So I'll talk about temporary speed breakers first because that is where value opportunities tend to arise. So temporary speed breakers refers to one-off external events which lead to a big stock price sell-off, and sometimes they also lead to a depressed earnings for a particular quarter, thus setting up a easy comps or easy year-on-year comparison for an earning speed in the subsequent year. So these temporary speed breakers are driven by various factors. Number one, trade wars. So Donald Trump imposed 25% trade tariffs plus 25% non-trade tariffs on India, a total tariff of 50%. As a result, the US focused export plays from India, basically those stock prices started collapsing very sharply. So we had a company called Carousel in India. It's one of the leading players globally in kitchen sinks. So when the tariff announcement came, then also the stock price of Carousel sold off because US is a big market for them. Additionally, recently Donald Trump imposed the additional tariff on kitchen cabinets, but Carousel is not into kitchen cabinets; they're into kitchen sinks. So just the mention of the word kitchen in the tariff announcement led to a further stock price sell-off in the Carousel stock in India. And one more example, Goldie International. It's India's largest integrated producer and exporter of lab-grown diamonds. That stock also basically sold off on the tariff announcement earlier this year. So what do you do in these such cases, in these temporary speed breakers because of trade wars? You basically put them on your watch list and then track them closely, because as soon as the trade deal is announced and once this overhang gets resolved, that is when you can see a sharp upsurge in the stock price of these companies who have been badly beaten down because of the tariff announcement. So basically, investing is a fine balance between defense and offense. What does defense mean? Defense activity in investing is basically building your watch list, basically researching new ideas, adding them to your watch list, and then patiently waiting. Offense is when you actually pull the buy trigger because you're prepared, right? Preparation, basically leads to good luck in investing, right? Opportunity favors the prepared mind, like we say. So you now that you have prepared your watch list diligently, just patiently wait. As soon as on the first sign of positive news flow, that is when you initiate these positions and make good profits. The second temporary speed breaker can come from geopolitical tensions. So India and Pakistan engaged in a kinetic war earlier this year, and there was a stock called Innova CapTab which sold off as soon as the Indo-Pak war broke out. Why did that happen? It's because this company's big earning trigger in the future is their Jammu plant, and because Jammu and Kashmir was at the heart of the conflict for the India-Pakistan war earlier this year, and because this company's major plant was based in this location of Jammu, there was a big sentimental impact on the stock, and the stock price collapsed as soon as the India-Pakistan war broke out. Again, you added to your watch list, and once the ceasefire was announced just in a few days' time, because you were again prepared, you could basically initiate a position, because the long-term fundamentals are basically unchanged. The ceasefire happened within just a few days, but within those few days itself, the sentiment became so negative that the stock price had sold off. Another temporary speed breaker, climate. Now, very few people think about this, but even climate can lead to a temporary speed breaker. So there's a stock called EPAC Durable. It's basically a contract manufacturer for branded air conditioning companies in India like Voltas, Daikin, and others. This year in India, we had very mild summers and very heavy monsoons. Okay. As a result, this company reported a sales degrowth in the June quarter, and the earnings basically collapsed. Earnings fell, and as a result, the price to earnings ratio optically went up. Basically, if the earnings fall down, then the price to earnings go up, right? So optically, the P ratio started looking very high. However, this has now led to a much more easier comp to beat year on year than in the subsequent year, next year. Place this again in context. AC penetration in India is very, very low, and EPAC Durable is part of a larger growth theme of electronics manufacturing services, EMS space in India. It's a very hot theme. And just because of a temporary disruption, because of heavy monsoons and mild summer this year, the stock price basically has fallen 35-40% very sharply. So next year, even if we just have a normal summer, they'll be able to have a very big earning speed just through that itself. So climate is one more basically temporary speed breaker. Another speed breaker, taxation changes. So recently, the government of India, as part of their indirect tax changes, they increased the indirect taxes on sin goods like liquor and alcohol from 28% to 40%. As a result, some of the stocks of branded alcohol players like Allied Blenders and Distilleries, Tilaknagar Industries, these stocks started selling off. But you have to view things from first principles approach. For certain goods, the demand is relatively inelastic for even a 10% increase in price. You have to ask yourself whether an alcoholic who enjoys a particular brand of whiskey will he stop consumption if the price of his whiskey goes up from 1,000 rupees to 1,100 rupees. It's very unlikely. He'll basically he'll pay that extra 10% price and still enjoy buying his favorite brand of whiskey. So even in such cases, because of taxation changes, you may have a sell-off in the, because of negative sentiment in the short run, you get a sell-off in the stocks of such branded alcohol players also. Fifth and final temporary speed breaker. Simple, disruption, short term transition disruption, or basically some, if a company is having any IT outages or some short term disruption in their business operations, even that can lead to a sell off in the stock price. So in India, the largest commodities exchange is called MCX, Multi Commodity Exchange. 2 years ago, they were transitioning from their previous IT vendor, 63 Moons Technologies, to TCS, Tata Consultancy Services. But during because the transition of their IT infrastructure from the previous IT vendor to the new IT vendor took 6 months longer than expected, their business suffered some technical challenges in the interim period. Earnings suffered, and the stock price basically fell sharply. But a commodity exchange, a dominant commodity exchange with almost 100% market share, benefits from strong network effects. If you simply were willing to be patient for just two quarters, once the IT transition was completed, you knew that there would be an upsurge in the earnings of the company. This is just a short-term internal IT disruption, but you have to basically have a positive view on the underlying business long-term prospects. So these are the 5 different temporary speed breakers which can happen. These are very different from permanent speed breakers. So what is a permanent speed breaker? It is when the industry structure or the competitive landscape basically changes for the worst permanently. For example, the Indian paints industry, for a long period of time, it was dominated by two players, Asian Paints and Berkshire Paints. But now, in the last 3-4 years, with the entry of very big conglomerates like the Birla Group, the Adani Group, the GSW Group, so much capital is entering that industry. And if you've read Capital Returns by Edward Chancellor, you know that when a massive amount of capital starts entering an industry and competitive intensity rises, the margins and return on invested capital start going down. So this is a permanent speed breaker. There's one more form of permanent speed breaker: damaging government regulations, which can permanently alter the underlying business's economics or profile. For example, recently the Indian power regulator made some changes to the industry, because of which the industry's dominant power exchange, IEX, Indian Energy Exchange, will now no longer be an exchange. It will be more of a power broker, and brokers get much more lower valuation multiples compared to a dominant exchange, right? So that is again a permanent speed breaker. One more example: the Indian capital markets regulator SEBI is thinking of doing away and removing weekly option expiries and turning them into monthly expiries only. That may have a significantly adverse impact on the earnings profile of a company called BSE, Bombay Stock Exchange, because a large part of their profitability is coming from these weekly, option trading. So you have to be, very aware of, when it's a temporary speed breaker, which may give rise to long-term opportunity, or if it's a permanent speed breaker, which can, completely derail the fortunes of the business.
That's amazing, Gautam. Not only do you have all these frameworks, but within the frameworks, you're classifying them as temporary issues versus permanent things. The next question I was going to ask you was actually going to be about tariffs, but you already covered that as one of those temporary speed breakers that is creating opportunity for you if you had a long enough time horizon. So that's excellent.
So we're wrapping up this podcast, and we'll wrap it up with a rapid fire round where we're going to ask you a few questions and then just a very short 1 word, 2 word, maybe a few sentences at most answers.
So maybe can you tell us a little bit about any books that you've read or podcasts that you've listened that you particularly enjoy or find actionable advice from? Because there's a lot of podcasts out there, but finding actionable advice from them is not quite as easy. So any favorites that you'd like to mention?
Right. So 3 books have shaped my investing philosophy. I'll mention them to you. So You Can Be a Stock Market Genius by Joel Greenblatt taught me how to invest in special situations. Then, Investing for Growth by Terry Smith taught me how to invest in high quality businesses for the long term. And, Capital Returns, which is edited by Edward Chancellor, taught me the capital cycle theory and taught me how to invest in deep cyclicals and commodities. That's about the investing side, these 3 books. For non-investing, I would recommend 3 exceptional books. First one is Seeking Wisdom by Peter Bevelin, one of the best books on multidisciplinary thinking. Then Poor Charlie's Almanac, edited by Pete Kaufman, a great book for investors and non-investors alike. And the third book is again a book by Peter Bevelin. It's called All I Want to Know Is Where I'm Going to Die, so I'll never go there. one of the best books written on the theme of inversion. So these three investing books and three non-investing books, I think along with them, I would also print out the Buffett partnership letters and the Berkshire Hathaway letters separately. And I think that would be an entire investing university by itself.
Absolutely.
That makes perfect sense. And then another one we always like to ask is there anything you like to do in your free time, maybe not even related to investing?
I love to travel a lot, so I do travel frequently with my wife and my friends as well. And also like watching movies, both Bollywood and Hollywood. And I like basically I love reading on various topics. So it's not just about investing; it's just to you know full just to fulfill this intellectually curious bent of mind which I have. So I like to just keep learning what's happening in the world generally.
Awesome. Thank you for this wonderful conversation, Gautam.
Mm-hmm.
We both had a lot of fun. We learned a lot, and we hope our audience did as well. So, thank you for coming on. Hopefully, we'll have you back on once more. I know you're a busy person, but just the wealth of information you shared with us today, it'll be wonderful to have you back on this podcast in the future.
Thank you for having me on the show. This was fun. Thank you, Asif and Tamanna.
Thank you once again. And that wraps up episode 42 of the Special Situations Report. It was absolutely wonderful having Gautam Baid on as our guest for this week, and we'll go back to regular programming next week covering all event-driven activity. However, if you'd like to access a more comprehensive overview of all Special Situations activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast as much as we did today, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.